nerves were already frayed in the jobs market and the bond market, and then we got this jobs print. What actually stops this sell-off?
Yeah, Katie, I think it's really one of two things here. It's either that we see more pressure on the equity market, driving more of this flight to quality flow back into the risk-free asset, which is treasuries, or we need to see a more substantial turn in the data that gives the market more confidence that the Fed is going to be cutting eventually. It's really one of those two things, and I think that today's data print really puts us more squarely in the view that it's probably more upside to come for rates near term.
Potentially more upside to come. RJ, I want to bring you in here because I'm taking a look at your notes, and you write, this pain should pass. Evidence suggests that the move up in longer yields is nearing an end. Where's the ceiling? Have we already seen it?
Well, I don't know if we've already seen it. I think we're nearing the end, however. I think in the post-pandemic environment, the economy has proven to be much more resilient and much more inflationary than we thought, if you look over the last 2 years or so. I think as a result, the Fed and the markets are grappling to figure out where is fair value. What is the new post-pandemic equilibrium level of yields? The Fed has an R-star of 2.5 in the dots. That's probably dated. The market now thinks R-star must be somewhere up in the 4% range. At this point, value has been restored to the fixed income market. The market is trending almost as if it's all momentum driven. But there is some fundamental value that should assert where equilibrium yields are. And we think we're much closer to a point now where people need to be looking at fixed income and saying, you know, nearly 5% yields on a 10-year, 5% on a 30-year. These are attractive yields, and that the equilibrium yield post-pandemic will not be 2x what it was pre-pandemic.
Meghan, come in on that. Has your base assumption of what R-star is, where the equilibrium rate in the bond market actually is, has that changed over the past couple months?
Katie, you know, I think that mentality really is what's caused a lot of folks in the real money community to be early, long, and wrong in this view. And one of the most surprising things that we've seen alongside this very significant sell-off over the past couple weeks is that it's been pretty orderly. We're actually seeing liquidity go down quite well. You know, speaking with our trading desk in London all this past week, really flows have been generally normal. You know, what I've been really most concerned in looking at alongside these moves are we seeing that capitulation from the real money community? And surprisingly, despite this pressure higher on rates, we're really not seeing that yet. So despite the fact that rates right now are very far above what the Fed is telling us and economists are telling us where this neutral rate can sit, I think that there's just more pressure that we could see come if you do have that capitulation from investors that have been buying rates for that mentality for months now.
Okay, so maybe no one's hitting the panic button, at least just yet. And it was interesting. We heard from San Francisco Fed President Mary Daly earlier in the week, who found a little bit of a silver lining in this bond sell-off that we're seeing.
The bond market has tightened quite considerably, over about 36 basis points since we met in September. Well, that is equivalent to about a rate hike, right? And so then the need to do tightening additionally is not there.
And RJ, to that point, when you think about what this means for the Fed, when you think about what we've seen, particularly at the long end, what we've seen in real yields, how much tightening has that actually done for the central bank?
Well, I think the Fed's probably, up till recently, the Fed might have been a little frustrated about how longer yields hadn't moved. Maybe in the next tightening cycle, they'll think twice about having sharply inverted dots in the dot plot. Typically, the 10-year Treasury yield rises and matches the terminal Fed funds rate in a tightening cycle. This time, that has not happened yet, but in part, that was because the Fed had been telling us they will tighten drastically to fight the inflation problem, and then they will ease in 24 and 25. I think one of the new developments in September was that they've diminished that easing. They've raised the trajectory of the Fed funds rate in the next couple of years. The markets are struggling a little bit to figure out where is fair value because they don't know that the Fed knows where fair value is. I would suggest that a 5-year forward OIS that's around 440 right now, 5-year forward at 440 is very high in real space and suggests that fixed income investors are going to do better prospectively than we have done recently. Meghan makes a good point. Maybe there hasn't been panicky capitulation, but the gapping higher of the market tells you there isn't a fundamental sense of confidence about valuation. And I think at this point, when you're staring 5% pretty much on your screen, you start to think that real yields are the highest they've been since the late 1990s. Value has been restored. We need to start legging in. No, we don't have certainty, but I think that just trading this market like a momentum market, you're probably going to miss the turn.
Well, actually, to that point, I want to talk a little bit more about duration, because when you think about rates, 10 years, 30 years, all near 5%, what does the risk reward of going out the curve right now look like? Of course, rates could go higher, but if we dropped, I mean, what kind of payoff are we looking at?
The skew is clearly favorable. I mean, at this point, being in cash year to date, undeniable winner. And we at Federated Hermes, we manage hundreds of billions of dollars in money market funds. We're very happy with the performance of those funds for our clients. But from a prospective standpoint, looking forward 12, 18 months, if you're adding to a fund that's got a 5.5 or 6 year duration, you're introducing much greater upside now than you have had in the fixed income markets over many, many years. For a long time, we were dealing with a low income fixed income market. That income has been restored. With that income and the prospect of duration, you actually have some upside in years to come. Now, where have we settled down just yet? Clearly not. Today's jobs report was red hot, broad-based strength. The economy is clearly doing well. We think that this might be the last gasp. It's going to slow down in coming quarters. We believe the consumer is going to be tapped out of excess savings, and the cumulative impact of all this massive rate increase is going to have significant impacts on the economy. It's already had a huge impact on housing. Housing affordability index from the National Association of Realtors is the lowest in the history of the index. These things are ultimately going to exert restraint on the economy. The laws of economics haven't been revoked. They've just been muddied by the pandemic and what has followed it.
And maybe that's what the tightening of financial conditions actually looks like in the real economy. But let's talk a little bit more about duration here. I actually caught up with Jeff Sherman of Double Line Capital earlier in the week on that question. Let's take a listen.
I like duration risk a little bit better today. I still like the credit we own. You can hear it. You can see it from the portfolio, the way they're positioned. But I like the duration risk given the sell-off and where yields are today.
And Meghan, I want to get your thoughts on that, because, of course, people look at yields and they say, oh, my goodness, bonds are losing so much money for you this year. But when you think about a 10-year, a 30-year at 5%, do you lock that in now?
Katie, I'm really not so sure, because if we're thinking about extending duration further out the curve, you're also thinking about almost levering up on that duration risk as well. What we have more certainty on right now is the direction of the curve overall. And I think that from a path of least resistance perspective, we need to be looking at steeper curves. That itself can help incentivize demand further out the curve if we do indeed see rates out there begin to look more attractive versus front-end rates. But I think that if I were to pick a point on the curve to buy right now, it would be more so towards the front end of the curve, particularly in real yields, where we see front-end break-evens priced sub 2% right now on an inflation basis. I think that these steepener positions are beginning to look more favorable and attractive, particularly when we're looking at the degree of cuts that are priced for next year. I feel like I was on here, a couple of weeks ago talking about the potential to see more of these cuts come out of the market pricing, and we've seen that. And at this point, that's making these curve steepener positions begin to look more attractive to us.
I'm glad you brought up the curve, because if you take a look at the 2s-10s curve, of course, a byproduct of these rising long end rates has been a remarkable re-steepening. The 2s-10s currently at about negative 30 basis points. I remember when we were in double digits not too long ago. And Meghan, when you think about what's going to drive that curve back to positive territory, are you thinking about a bull or a continued bear steepening here?
I think, Katie, that what can come first, and really what the pain trade is going to be to the real money community, is this continued bear steepening. What I've been talking a lot with clients about this past week is this wave of duration supply that we have coming to the market because of the size of deficits, the fact that the Fed is still reducing the size of its balance sheet. We've only just begun to see that wave of supply come through because so much of that had been previously financed from front-end supply, treasury bills, where we've seen a lot of demand from investors. I think absorbing that duration supply, that coupon supply, is going to be a lot harder, which means that we could see more room for this bear steepening to persist. But once real yields do ultimately break something, which we think will happen, that steepening will move back to a bull steepening. And thankfully, it's the same trade for either.
And RJ, I'll let you have the last word here. When you think about the yield curve, how deeply inverted we've been, how less inverted we're going, what do you think actually gets us back to positive territory, and when?
Well, Meghan hit the nail on the head. I think for a while, the real money community, and we are squarely in the real money side here at Federated Hermes, we felt that the steepening would be solved in a bullish fashion, and obviously that's not what has happened here. The resilience of the economy has been far stronger than nearly anyone expected. I don't believe there was a single economist today, for example, who predicted the non-farm payrolls blow out north of 300,000, and yet that happened. So the economic strength has caused a massive repricing in a world where there's a lot more debt than there used to be, a smaller Fed balance sheet where there used to be, and more attenuated market making than there used to be. Hence, you've had big moves. I think that the curve, in fact, is at this point uninverting to some degree because people are reevaluating the trajectory of the Fed funds rate and they have low confidence. If you have low confidence, the term premium should go up, curves should start to uninvert. That's what's happened. It's been a bearish steepening, not a bullish one. But from 12, 18 months out, I think we'll see the opposite develop, where the economy will slow from the interest rate shock. The something that breaks out there could be commercial real estate, could be private debt. We already saw the stress in the banking system. I still believe that we are at a point now where yields are presenting some value. Is it the absolute bottom of the sell-off? Very hard to call that. But is it a point where you start considering diversifying the risks you take from cash to edge out to the short end of the curve or intermediate? We think the answer to that is yes.